Hey, it's Nolan Mathias from Mortgage 360, and today we're talking fixed versus variable rate mortgages and how to choose the one that's right for you in 2020. And at the very end of this video, we're going to give you the exact strategy that we're using on our variable rate mortgages, so stay tuned for that. But before we get into it, do me that favor, hit that notification bell, hit the subscribe button, and please hit that like button because ultimately the amount of people that see this video and find this information is completely up to you and whether or not you hit that like button. So please hit it now. So let's get into it. Fixed versus variable rate mortgages. How do we choose the right one for you in 2020? And when we talk variable versus fixed rate mortgages, we talk about two criteria primarily. One is your risk tolerance, and two is what interest rates are doing at the time. So let's talk first about risk tolerance, because that by all means is the most important thing when it comes to choosing a fixed versus a variable rate mortgage. And obviously we aren't meeting with clients face to face right now, but typically when we are meeting with clients face to face in a non-COVID world, now we're doing it over Zoom, of course. Basically what we do is we will sit a couple down across the table from us and we'll say, how would you feel knowing that your interest rate could increase overnight and subsequently your payments could also increase overnight as well? And then what we'll do is we'll watch their body language. And typically in a couple, there's usually one that's a little bit more risk averse and one that's a little bit more risk tolerant. So we'll look at the one who's a little bit more risk averse and we'll kind of assess their body language and how they feel about the prospect of their interest rate going up. And if there seems to be quite a bit of aversion to a variable rate mortgage and that fluctuation, we'll kind of hash that out and we'll talk about, worst case scenarios. So what would happen if interest rates went up by 1%, 2%, 3%? What would that look like from a payment perspective? And then we'd basically have them assess for themselves whether it makes sense for them to take that variable and whether they would be able to withstand the pressure of an increasing interest rate. Now, you can do this at home as well, because what you can do is just go and find a mortgage calculator, put in your mortgage amount, put in your amortization, typically it's 25 years, and then put in an interest rate like what the interest rate would be today, which is about 2.25%, and then increase it by 0.5%, and then increase it by 0.5% again, and 0.5% again, and then 0.5% again. And then kind of figure out where you start to get uncomfortable. And if it's around, 1% higher, then variable rate's probably not the best thing for you. If it's about 2% higher, then, maybe variable rate might make a pretty good strategy for you. But if you start getting uncomfortable at an interest rate that's 3 to 4% higher, then probably not a good idea to take a variable rate for right now. And we also want to make sure that you're as comfortable as your partner and your partner's as comfortable as you, because when it comes to mortgages, I mean, the number one thing that breaks up couples is finances. And, Mortgage 360, we never want to be in the business of breaking up relationships. Like, we're not divorce mediators. We're not in the divorce business. We're not family lawyers. We're mortgage brokers. So what we want to make sure is that we give you the best chance to succeed. So it's important to make sure that you and your partner are on the same page when it comes to variable versus fixed. And not the same page from the perspective of, yes, I convinced him or her that they should take a variable, so now they're on the same page as me. It's like, how do they really feel about it? Would it really create stress if interest rates go up? And if that's the case, probably best to avoid variable rate mortgages. Now, let's say you are all about the numbers and what's going to save you the most money. Then let's talk about variable rate strategy and what to look for in interest rates in order to determine whether you should be getting a variable or not. And one thing to keep in mind is when we talk about variable rate strategy, we're not just talking about variable rates, but we're talking about short-term mortgages as well. So as part of a variable rate strategy, we'll look at the variable rate, and we'll also look at the 1-year and the 2-year mortgages. And the reason for that is because essentially a 1 and 2 year mortgage is a variable rate strategy, because we know that the payment and the rate's going to adjust in a year or two. So we look at those with the same eyes that we would look at a variable rate. And what we typically do is we choose the mortgage that has the lowest rate at the time that we're getting the mortgage. So up until this last couple of months, 5-year fixed were actually the lowest rate on the market. They were lower priced than variable rate mortgages, and they were lower priced than 3 and 2 and 1-year mortgages. So most of our clients were choosing 5-year fixed, even if the variable rate strategy was the right strategy for them. Now, that being said, we didn't know that this pandemic was going to happen. We didn't know that rates were going to go through the floor. And therefore, we had some people that picked 5-year fixed that were at a higher rate than what the variable would have eventually ended up at. But who would have been able to make that prediction? So all we can do is deal with current information when we're choosing a variable rate strategy. And the way we do that is by choosing the mortgage that's the cheapest at the time that we get the mortgage. And also, think of it this way, it's also the cheapest when the mortgage is the biggest, because when we're getting a mortgage, that's the largest our mortgage is ever going to be. And as we make payments, the amount of principal is going to get paid down and the mortgage is going to get smaller and smaller and smaller. So that's why we always believe in taking a lower rate, a variable rate strategy when the mortgage is the biggest, is because that's when it's going to save us the most money. So let's look at a real world scenario. Now, keep in mind with this whole coronavirus thing, interest rates are changing daily. In fact, we've never seen them change faster. So we have to be cognizant of the fact that as I film this on May 4th, on May 5th, the rates may be completely different, and they may be completely different again on the 10th or the 15th or the 20th. So just use this information as an example and use it as a criteria for looking at interest rates when you do go to get your variable rate mortgage. And if we look at today, May 4th, 2020, right now, prime rate is at 2.45%. And the best discount in the industry right now is about a quarter point off of prime. So prime minus 0.25. So therefore, we can get a variable rate at 2.2%. Fixed rates, on the other hand, are at 2.59% for the comparable product to what this 2.2 variable would be. So there's a 0.39% difference. So what that tells us is that the variable strategy may make sense. Now, here's the thing. Where's the threshold? Where does it really make sense to take a variable over a fixed? Because what the data tells us is that if the interest rates are the same, we'll probably benefit from a variable rate strategy. But do we really want to take that risk when there's no room for interest rates to go significantly lower? So what we like to look at is that difference and where we feel comfortable getting a variable rate mortgage. And where we feel comfortable is if the interest rate is a quarter point to a half a point lower than what the comparable fixed rate is. Now, in this scenario, interest rates are about 0.39% apart. So yes, it starts to make sense for us to look at variable rate mortgages. And that's exactly what we have, is we have a 5-year variable mortgage on our rental property. We have it on our personal residence. And we're keeping those mortgages because they're significantly lower, at least lower enough for our risk tolerance than what the comparable 5-year fixed is. Now, once we've decided if the difference between variable and fixed is enough for our comfort level, then we need to go about choosing the right variable rate mortgage. And that's important here because what you need to consider is 3 things. You need to consider how the lender that you're choosing does their lock-in rates. You need to consider what their lock-in rates will be. And you also need to consider whether or not you can move the mortgage later on down the road if that lender 3 or 4 years down the road is no longer competitive in their variable rate lock-in rates. Because what you don't get to do is you don't get to say, okay, I'm paying 2.2% right now. I'm on a variable. I want to lock in, and I'm going to lock in at 2.2. It's not how it works. What you have to do is you have to pick a comparable fixed rate mortgage that is greater in length than the amount of time you have remaining on your mortgage. So if you have 3 years left, you have to pick a 3-year fixed or longer to lock into. And if the fixed rate mortgages aren't competitive at the lender that you've chosen, then you could end up having to lock in at a higher rate. So picking the lender that has the best lock-in rates is pretty important. And right now, the 2 biggest lenders in the industry, 2 biggest non-bank lenders, are about half a point apart on what their lock-in rates are. So if you chose one over the other, you could end up paying substantially more when you go into lock in your mortgage down the road. Now, the second thing you need to consider is whether or not you can even move, because there's a product out there that has what's called a bona fide sale clause or a no refinance clause. And almost every lender has some version of this type of mortgage. And the problem with it is if you take a variable and discounts go down, so let's say they go from prime minus 0.25 to prime minus 0.95 again, and you've got a no refinance or a bona fide sale clause, then you can't switch into a lower variable rate mortgage. And also, you can't switch to a different lender and get a better lock-in rate on a fixed rate term if you've got those clauses. So it's important not to have them. Bona fide sale clause, no refinance clauses in variable rate mortgages right now are a big no-no. You don't want to do it. And then the third thing you want to make sure that you have is a fair penalty, because some of the variable rate products out there have what's called flat fee penalties. So maybe it's 1% or 2% or 3%, or maybe it's at a scale. So in the first year, it's a 5% penalty. In the second year, it's a 4%. In the third year, it's a 3%. In the fourth year, it's a 2%. And in the fifth year, it's a 1% penalty. Those products, we want to make sure that we don't have those either, because again, if your penalty is high and you can't switch to a different lender, if you don't have the option, then you end up being put in a situation where the lender can basically say to you, okay, you want to lock in? You're paying this rate, and it's maybe substantially higher than market. So, making sure that your mortgage is not only movable, but that it has a 3-month interest penalty and no restocking fees, because that's a huge thing in the industry right now, is $900 to $1,000 restocking fees. And also making sure that the 3-month interest penalty is actually at what you're paying in interest, not at prime. Because what we're seeing right now is we're seeing some lenders that have 3-month interest penalties that are at 2.45% instead of being at 2.2%. So, making sure that we're paying attention, that we know exactly what goes in that mortgage is really important. Now, here's the thing. In that 30-page document you get when you sit down at the lawyers, there's all these terms, all these conditions. And the chances of a consumer picking out the terms and conditions that are really important when choosing a variable rate strategy, or even a fixed strategy for that matter, are pretty small unless they're a lawyer and they're reading through the documents and they're familiar with mortgage documents. We've seen lawyers that aren't familiar with mortgage documents get confused with financial terms before. Then there's a pretty high risk that you're going to get stuck with something that is a surprise. So having a mortgage broker that takes honesty, transparency, and accountability seriously is really, really important, especially when you're choosing a 5-year fixed mortgage. And by the way, don't think that your banker, the person who is employed by the bank, whose paycheck comes from the bank, has any obligation to you to tell you if the mortgage that you're choosing has a bona fide sale clause or a higher penalty. Their job is to get you to sign on the dotted line and sell the benefits and the features, but not necessarily the restrictions of their mortgages. So really important to make sure that you've got a flexible mortgage. And again, that variable rate strategy comes down to two things. Is the risk tolerance acceptable to you? And is the rate that you're getting at the time the lowest possible rate you can get if you're choosing that variable rate strategy? And that's really it. And all we do is we pick variable rate mortgages. We have them with a big bank. We understand that our variable rate mortgages that we have with a big bank are probably going to have high lock-in rates. And we know that when we go to lock them in, we're probably going to shop those rates around and go to other lenders if we decide to lock them in. Now, I'm an economist. I know the math. I know the data. The chances of us locking into a 5-year fixed term are pretty slim. We've been in 1-year fixed before. We've been in 2-year fixed before. In fact, the mortgage that we most recently renewed in August of last year was in a 2-year fixed mortgage. And that was because that 2.5 years ago, when we went to get that mortgage, the 2-year fixed rate was significantly lower than what the 5-year variable was. So, we practice what we preach on this. We are variable rate fans, but only when the risk tolerance is something that we're willing to accept. And when we know that we're getting a good enough deal off of what the fixed rate would be, that it's probably going to make sense long-term for us to be in that variable. So that's how to choose a variable rate in 2020. Do me that favor once again, hit the subscribe button, hit that notification bell if you aren't already subscribed, and do me that huge favor, hit that like button to make sure that this information gets sent to the top of the YouTube rankings and gets shared with as many people who are looking for that fixed versus variable rate strategy as possible. Cheers, we'll see you again soon. Thank you so much.